Well, good morning. I'm Jaginder Rana. The topic of the day is parametric insurance in India. Parametric insurance in India. The term parametric insurance describes a type of insurance contract that insures a policyholder against the occurrence of a specific event by paying a set amount based on the magnitude of the event, as opposed to the magnitude of the losses in a traditional indemnity policy. So, simply put, parametric insurance provides fast lump sum payments upon the occurrence of a predetermined data metric. By expediting the claims process, policyholders' insurance creates an opportunity to improve the policyholders' experience, building loyalty and trust. Parametric is not new. It has been used for almost 25 years in large scale transactions such as catastrophe bonds in both the private and public sector. So what is new, however, is the extension of parametric to the consumer level. Only now is data sufficiently available and technology adequately matured to enable the immediate data-triggered payments of parametric insurance. So when used as a consumer insurance product, parametric must be structured so that it meets the definition of insurance. Because the most common hurdle in classifying parametric as insurance is its inherent basis risk, the difference potentially quite large between the insured losses and the payment amount received with disbursement amount fixed in advance. So the insured necessarily experiences either a windfall, that is payment exceeds the loss, or a shortfall, that is losses exceeds payment, never a precise reimbursement. So shortfall occurs routinely in all insurance, although windfall is known to occur occasionally. It is not the intention of any insurance policy, whether parametric or not. Thus, the most defensible parametric policy is one that minimizes the chance of windfall. So, many existing insurance products already incorporate the attributes of parametric: speed, transparent settlement, criteria, and fixed dollar amounts, even if they are not called parametric per se. Here are a few examples of parametric like insurance of consumers. Accident insurance, fixed amount payment triggered by a specific accident. So trigger data is available and verifiable from third-party medical records. Loss and payments are correlated because payment amounts are derived from well-established data on medical losses. Then travel insurance, a specific compensation triggered by cancellations or delays. So trigger data is based on publicly available real-time flight database and pricing. Losses and payments can be tightly correlated to the cost of alternative plans. So parametric is not a substitute or replacement for conventional indemnity insurance. For consumers, the primary advantage of parametrics are speed of payout, speed of payout, because speedy payments or payouts prevent policyholders from having to tap savings or credit to pay their losses to the insurance company. The development of immediate funds prevent follow-on losses. Then this sense of certainty. The customer knows the precise amount to be received and under what circumstances. So in contrast, indemnity settlements are inherently uncertain. Research consistently shows that human brains do not process uncertainty rationally. The greater the uncertainty, the more distrustful and adversarial customers behave. The parametric alleviates disrupt by building in certainty to the outcome. And then transparency. This is an element of trust when triggered data is equally available to both the insurer and the policyholder. It reduces the perception of unfairness. So from the perspective of the insurer, the primary advantages of parametrics are customer retention. Parametric policies represent an opportunity for insurers to surprise and delight customers, thereby building trust and loyalty with fewer cancellations. With parametric policies, capped liability is there. Insurers knows the total amount of liability with a high degree of certainty. This is particularly material for high severity, low frequency events where uncertainties are high. And simplified underwriting. Fixed and capped payouts simplify underwriting. Individual risks can be priced and selected solely on the possible probability of the trigger. This accelerates sale by reducing the amount of data and the time required to quote and bind a policy. So when determining which risks are suited to parametric, Lloyd's state any risk with a loss outcome can be a candidate for parametric insurance, provided that the data is reliable and third-party verifiable, and that a statistically significant correlation between the loss event and the insurance payment is established. So data reliability is key to this definition. For consumer applications, the most credible data to use as a parameter is that from a transparent, indisputable source, real-time availability and API connectivity also facilitate automation. Good sources for parameter data include public agencies, sensors, whether specific to the risk insured, for example, auto sensors or a nearby proxy, and third-party open data. So the influence of frequency is for frequent data-rich events, parametric policies should be designed so that losses and payments are well correlated. The illustration earlier on travel cancellation is one of such example. Some types of auto accidents might also be relevant. On the other hand, rare events such as natural disasters are data poor, but it is still possible to achieve parity between losses and payments, and thus minimize basis risk. So method of doing so depend on whether a policy is pure parametric or partly parametric. These differences are highlighted. Say, consider a spectrum of insurance products from indemnity only on one extreme to pure parametric on the other. So pure in this case means that the payment is based solely on data with no other claims adjustments. Many product possibilities combine some principles and advantages of indemnity insurance with those of parametric insurance. So imagine these examples. Two-phase. This idea for a policy would pay the first portion of losses parametrically upon exceedance of a specified trigger and the remainder through indemnification. Then multi-tranche. This idea for a policy would be parametrically in multiple tranches. The first payment occurs without documentation or adjustment of loss, but payments in follows on tranches require increasing degrees of loss itemization and claim adjustments. So adjusters triggered. This idea for policy would pay parametrically upon being triggered by the adjusters. The adjuster ascertains whether the payment threshold has been met. This could be the case, for example, for a policy triggered by an on-site sensor that is accessible only by the adjuster to minimize the potential for tampering. So in these examples, the claims professional remains essential, but the adjusting process is less stressful, it's less time sensitive, and the policyholder has already had the positive experiences of receiving an initial payment. So, what is the future of parametric insurance? See, the parametric has enormous potential to help close the protection gap, to begin covering severe low frequency risks that up till now have gone largely unprotected. Not just weather related disasters, but cyber terrorism, political unrest, pandemic warfare, global economic downturn, and more. So, meanwhile, the explosion of data from artificial intelligence and machine learning is multiplying. It ties up risk that can be covered by parametric insurance. Imagine, for example, that a parametric layer of insurance is routinely bundled with indemnity policies so that customers receive immediate payouts. So the same day as a severe storm, an auto accident, or a widespread power outage. So the magnitude of the payout needs to be large. So when a customer experiences frequent positive outcomes from their insurer, they are more satisfied with the insurer as well as the claims professionals who represent it. So, the parametric insurance is emerging as an innovation in the agriculture insurance space. Unlike traditional crop insurance, it provides a more flexible, faster and targeted risk management solutions. However, its adoption among Indian farmers remains limited. The parametric insurance differs from traditional crop insurance and its potential to transform farmers' resilience to extreme weather events. It has potential. Now, what sets parametric insurance apart? This is the question, because traditional crop insurance offers generic coverage, applying the same risk and benefits to all farmers. But in parametric insurance, one can define risk and coverage to their specific needs. So the customization allows farmers to address unique risks such as untimely rain during harvest or high temperatures during sowing, rather than generic perils like droughts or floods covered under conventional policies. So parametric insurance doesn't indemnify actual physical damage. Instead, payouts are triggered when the predefined parameters such as rainfall levels or temperature thresholds are exceeded. So the approach simplifies claims and ensures faster settlements. The claim process is faster and more transparent given the parameters are measurable and objective. So farmers often struggle with delayed payouts under traditional insurance schemes. Parametric insurance addresses the gap by offering quicker compensation. The index-based insurance products covers the essential risk like excess rainfall, complementing existing traditional insurance solutions. So this complementary nature helps expand the scope of insurability to include hard to insure risk. Now the question is, what is the challenges in adoption? Despite its benefits, the adoption of parametric insurance among Indian farmers, particularly in rural areas, remains low. Because the barriers are like high distribution cost for reaching remote farmers, limited availability of products from insurers, data challenges for perils like frost, which are crucial for triggering payouts, low awareness and trust among farmers further hinder adoption. So, with advancements in technology and better data collection, parametric insurance adoption is expected to grow. It holds the potential to provide a more resilient risk management solution. So when it comes to premiums, the direct comparisons between parametric and traditional insurance are not straightforward. The coverage and product structures differ, so the premiums vary accordingly. Thank you very much.